Portfolio Builder members, it is November 20th, and we have huge profits today from an outraged China over the U.S. Hong Kong bill. And so some interesting movements in the market. I do want to read a few tweets from a Chinese communist leader over there who has access to Twitter. Don't forget, it is outlawed in China unless you're part of the Communist Party. Hu Jihin. So a friendly reminder to American farmers, don't rush to buy more land or get bigger tractors. Wait until a China-U.S. trade deal is truly signed and still valid 6 months after. It's safer by then. Another quote from yesterday. If President Trump believes China's economy is crumbling and Beijing will eventually make decisive concessions, he has to wait until Ivanka becomes the president to sign trade deal with China. Chinese economy continues to grow with strong consumption. People are optimistic. Okay, guys, we'll jump back in today's trade alert. Quick little piece about what we do, and then we'll jump into the results of the current trade. Take a look at all of our open positions, and then we'll hop into all the news I've collected over the past 24 hours. Daily income trade alerts at noon Eastern. Our trade allocation per $75,000 is 54% in equities, $38% in bonds, and 8% in gold, with a target income of $750 a month per $75,000 invested. A lot of our clients are millionaires, so you just multiply that to get to your total portfolio size. Your trading schedule is the SPY ETF Monday, Wednesday, Friday at noon Eastern, with 100 shares, and that's a ratio of 2-to-1 against emerging markets on Tuesday. The TLT, that's your 20-year plus Treasury ETF, on Thursday, and also GDX, our gold miner ETF. So that's the schedule. The portfolio is highly uncorrelated, so we tend to generate a profit in one asset class at a time, and overall they're all traveling higher because central banks are lowering interest rates, printing money, and fueling the bubble. Now, will this last forever? Certainly not. Our target income is, again, $750 a month per 75K, or 1% a month. Our average return has been 1.35. There's been some months where we're slightly under, a few months where we're slightly over, and our worst return in a single month was only negative 1%. In fact, that's our only loss in a month. And over a 90-day stretch, we've never lost investors' money. I would invite you to click the description box below to sign up for a free educational webinar every Thursday at 2 Eastern. So that's tomorrow. Register now. I'm going to go through the big picture, how to predict the markets very accurately, and more importantly, what's going to cause the bond bubble or stock market bubble to pop. Let's take a quick look at our returns. What's important is the risk versus reward. Who cares if you can make 20% this year if you had to hold on to a 20% loss from October through December, and then also you had to hang on to a 7% loss in May, and you had to hang on to another 8% loss in August. In each of these months where the market fell, really unexpectedly, we generated great profits. So if you join our webinar, I'll show you how the TLT is the secret to generating profits when there's volatility in equities. So once you learn that, your life becomes so much easier, and you can see how our portfolio works so well. In fact, our simple 4 ETF portfolio is extremely diversified, and all you'll need for your retirement. The SPY ETF has 500 plus companies, the top in America, and emerging markets really covers most of Asia with 1,000 companies. So if you think your portfolio is diversified, my 4 ETF portfolio is much more diversified. And more importantly, it's diversified in different assets that are uncorrelated. Gold, bond, and equities all have different correlations that makes your portfolio very hard to lose money. And our goal is to generate income and safety, not growth or speculation, especially when we know we're at the very end of a huge market bubble that's about to pop. So you can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. Call Dean to reserve your spot or a free consultation at 505-322-7515. He's an expert options trader who can walk you through our entire program and get you signed up if you're not yet. Here's our disclaimer. Feel free to pause the movie, click the link in the description box if you'd like to read it. Let's jump into today's trading content. Okay, so I'll zoom out a little bit. Now this is what you'll have in your email. So if you're watching this and you want to go look at the details, go check your email. You get this daily. If you're on the expired list, you'll get it after the bell. So you'll miss out on the trade, but you can still track our results. And if you're on a free trial, you'll get it during the trading period at noon Eastern. So we've got a nice slideshow for the video cover now so that you get a quick glimpse at what you'll learn in the daily video. The big news is that the U.S. Senate passed a bill. I think it had a 100% vote on both sides of the party to support the Hong Kong protests and their rights for democracy. China is outraged, and we have a lot of content to cover in a moment about how they're reacting to this. Surprisingly, equities haven't sold off, but our gold and bond portfolio did go up. So overall, our portfolio gained in value. Okay, so let's look at the results of the SPY trade from Monday through today. So the SPY traded from 311.90 to 311.72, pulling back 18 cents. Now I was very cautious going into that trade and bought us a lot of downside protection. We had very, very little risk to the downside, and we paid 53 cents for our option collar, and we were able to get 45 cents back on that option collar. So that was an error. That's a plus, not a minus. And so the net result on the option collar was also an 8-cent loss, bringing our total loss to 24 cents a share on 1,900 shares, or a loss of $456. Now the TLT is up considerably, just under $2. We'll look at that in detail. But that profit of $7,220 really offset the SPY loss by a multiple of almost 15. Also, we've had quite a winning streak on the SPY. Now we're getting close to that danger zone. My expectation, which you can see if you click on this link, was that the SPY would travel to 315 on hopes of a trade deal, and we predicted that back on October 28th. So we've had quite a run up and captured a lot of profits. You can look at every single trade alert that we issued during this period by clicking on any of these links. It includes the video, the trade alert, every last little piece. So we're completely transparent and open for audits and for anyone who wants to really go through this with a fine comb and get out your magnifying glass. Okay, so we'll continue on into the trade alert. Here's our open positions. Emerging markets, essentially we lost a penny so far from the Tuesday trade. The ETF went down 2 cents. Our option collar went up a penny. So we paid 21 cents for downside protection, and we got so far 22 cents if we were to close that out today. So we're only down $38 on emerging markets, and it appears equities markets are still hopeful of a trade deal. Now, if we do get a trade deal, my new target for the SPY is 330, and I think that would allow emerging markets to break past 52. Emerging markets has been slacking a little bit. We picked up a nice return last month, but this month it's been somewhat slacking in terms of picking up pace with the SPY. So that's alarming and shows us that there's some pessimism that a trade deal really will be reached. Also, what's interesting is there's been a lot more volume flowing to emerging markets versus the SPY. So the SPY, everybody's just complacent, no one's selling, very low volume is pushing the price much higher, and mostly it's gapping up. So you're not even having the ability to trade this as a day trader, which is good for our portfolio because we're certainly not day traders. We only trade once a day, and it takes about 2 minutes. Okay, so current position on this allows us to benefit up to 44, but if anything goes hairy, we get 43 a share because we have that long put. So a relatively tight option collar currently on emerging markets, as it has been showing some weakness, so we played it pretty safe. TLT, we can profit all the way up to 141, and we've climbed to 140.10 from 138.16. So that's about a $2 move to the upside. Currently, we're up $1.90 after we pay back our option collar, the downside protection, and a profit of $7,222 on 3,800 shares. Again, you can view the trade alert right here in your email. GDX is only up 2 cents. We have a small gain on the underlying, but again, I was playing it safe. In case a phase 1 deal did come out of the blue, GDX is probably our riskiest position by far. And so we were playing it safe until things get a little hairier. And so far it's moving up a little bit, but the equities market's not getting freaked out yet. So I think the second we see equities sell off, you'll see GDX really pop. And meanwhile, the TLT is just climbing all on its own. And the big picture for the TLT is it must travel much higher, or else the U.S. government is not funded. It's just that simple. And we can take a look at that in great detail in our webinar coming up Thursday. That's tomorrow at 2 Eastern. So I do recommend you sign up for that. It's every Thursday. It's purely educational. There's no sales pitch. You're going to learn a lot. You're going to learn how the whole program works and be able to do it on your own. So whether you want me to do all the work for you or you want to just learn how this works, you'll see how to generate consistent returns with low volatility. And so here's our total return is at 14.92%, and that's in the first 12 months. So we're about to close out the 12th month, and we've outperformed our target by about 3%. My goal is to make 12 to 15% a year, no more. Anything other than that would entail taking on greater risk. And our clientele is all going into retirement. They can't afford to lose a penny, much less 5, 10, 20, 30%. So we've done a good job at protecting our assets, and we're close to closing out November with a profit. It's been a tough few months because we don't know whether the trade deal's on or off, and it's changing every other week. So we've been playing it safe, cautiously. I'd much rather have a flat return than try to guess and take on a big risk and get lucky to generate a profit. So again, we're not trying to speculate and get lucky. We're trying to play it smart, safe, pick up the easy hanging fruit, and we've done a great job at that. The SPY portfolio, when you pull out just the SPY, is up 1.5% in November. And you can see in our basket of potential ETFs for this portion of the strategy, we're all in on the SPY, and I suspect we will be doing that for the next 2 years until we get a major crash. After a major crash, I might want to rotate into some of these blue ETFs, and during a crash, we very well may put part of our portfolio into some of these inverse ETFs to help generate passive profits to the downside. But we're nowhere near ready to be long-term bearish on equities. And we'll take a look at our charts in a minute to show you the single best indicator for when you can expect a long-term bear market. I'm talking 6, 12, 24 months, not just a 1, 2, 3 month pullback. Okay, here's our emerging markets portfolio, currently holding EEM, safest way to play that. If, again, we had a major crash, a reset, rates went up and they're expected to come back down, this is way into the future, we might actually buy the best companies in emerging markets for a better return. But we're nowhere near that, and quite frankly, the Yang ETF, the inverse EEM, may be a position we put part of our capital into if things really do get hairy. Because the big picture for China is they have too much debt, they've misallocated capital. Just some highlights are they have 10 cities the size, at least 10 cities the size of New York that they've built that are completely empty. And they have 55 million apartments that are just concrete shells that are rotting away. So they've misallocated a ton of capital. Their growth rate is deaccelerating. They might sit there and brag about a 5% GDP, but most analysts think it's closer to 4%. And what's more troubling is the change. So the rate of change is deaccelerating very quickly, and so this is causing problems for all their trading partners. Now the catch is, why are we long emerging markets? Well, all the central banks are printing money, and they're artificially goosing their GDP higher by creating more government debt, and then two, the banks are buoying up these stocks because they're able to cash out their bonds for a huge profit to the central bank, who's a fake buyer, and now they have a ton of profits to brag about and put into the stock market. So we're in a bubble up mode, and we're headed towards war with China. And so that's really the bottom line. And we'll look at what would actually make us be long-term bears on U.S. equities. But if we start to shake emerging markets, I'd suspect we have a very similar result as 2018, where emerging markets tank, the dollar goes up, U.S. equities go up, and the TLT goes up. As people look for a safe place to put money, as they can clearly see China's crashing. And if we are able to cut them off of capital, they're in a serious problem. Okay, so moving along, we have our bond portfolio. This had a little bit of a pullback in October and November. In fact, it had a 99th percentile pullback, and that was after we came out with, guess what, phase one trade deal. The good news is this provided a great opportunity for us to get back long the TLT at a better price, and I suspect it will travel dramatically higher. And in a moment, I'll tell you how to predict what the highest peak the TLT could reach. And that's going to be based on going towards a 0% interest rate from the Federal Reserve. Right now, we're at 1.5 to 1.75. They're telling us they're on pause. But once Trump raises the tariffs and escalates this, I think that they may actually give us a rate cut this December. Precious metals, a few caveats to this portfolio. So when we started this, we were in December, and Powell was saying that we're going to have autopilot rate hikes. They're not worried about the stock sell-off in October and November. They weren't worried about the 10-year hitting 3% yield. They weren't worried about anything, and they're going to continue quantitative tightening. Well, the market had that Christmas massacre, and by February, they stopped the rate hikes. They did the Powell pivot. And then for the rest of the year, they've been cutting by 25 basis points. And after each meeting, they say, that's it, we're going to stand back and see what happens. And then guess what? Surprise, they signal a rate cut like a day or two before. And this is important because this is keeping investors holding their bonds. If they had any hint that rates would go flat or up, that would mean these bonds are completely useless because they're having a yield below inflation. And there's the only reason most people are buying bonds at this point in time is to try to catch a capital gain by flipping it to their central bank. So that's the game they're in. And as long as they give the perception that bond prices can travel higher and yields can go lower, this whole scheme can keep going for a couple more years. So we'll take a look at timelines of predicting when they run out of rope. But bottom line is bond market and precious metals is a great buy right now because governments are creating huge deficits. Central banks are buying that debt, expanding the money supply. That makes the relative value of things that don't grow from central banks go up in value, such as stocks, bonds, real estate, and even the barbellic relic gold. So in December, we started off with a tiny position, 2.5% in Bitcoin and Ethereum, and we caught a huge gain in that. That's why we have these giant returns in these early months. But once we actually saw the Fed pivot, that's when we started to increase the position size, take profits on the Bitcoin and the Ethereum, and rotate into safer assets. We played GLD for most of the year. As soon as we hit 1,500 an ounce, we rotated into GDX. That's the miners. So when I expect the spot price will rally, then I like to be in GLD. That usually happens first. Then the miners who produce gold can actually start making profit. So now it makes a lot of sense to be long GDX. So currently you can see we're all in on GDX. Once that has a significant rally, you could see this portfolio rotating some capital into SLV first, which would be spot silver, and then after that into the silver miners. So silver is just kind of like gold on steroids, more risky. It moves second. So first we want to catch the big gains on GLD, which we did. Next, we want to catch the big gains on GDX, which we've been patiently waiting for. We've had some drawdown in the last few months. Really, we have two ingredients we need. We have lowering interest rates by all the central banks. We have an increasing money supply. The third ingredient for gold is panic, fear. And so I think that's coming up very soon. So I love this position. Right now we've used a tight option collar, but I'm going to loosen the heck out of that as we see whether this phase one deal is going to happen or not. Okay, so that's a review of how we have our portfolio. And you can see after all the dust has cleared and we've crashed all these bubbles, that's when I would actually rotate into some different metals, which you can see right here: platinum, palladium, base metals, lithium, and uranium. But again, we want to do that after a period of reset. So we're a couple years out from that. There's no inverse products in this portfolio right here because there's just so many different assets we might want to play at different times. And we can use the option collar again to make a profit by owning the asset and then doing the inverted option collar. It's your best trick for playing downside. Okay, moving along, let's take a look at today's trade alert. First step is to buy to close the previous trade, which was the 313 call and the 312 put. And if you skipped the Monday trade, then you would skip this step and you can go straight to step 2. In today's trade, we went a little more bullish. I still bought that very at the money put, so we have very little downside risk. We're going to lose at most about $1 because we paid $1 for that put, and in fact a little bit less because the put's actually at a higher strike than the trading price. And then we sold an out of the money call, so we're going to generate profit if the melt up continues. And I'm kind of surprised that equities didn't sell off more from this Hong Kong bill passing. So it just shows you how much money is now in the system to push this bubble up, melt up further. Now, tariffs certainly would get a sell-off, but again, I still think it would be a short-term sell-off. So we'd only play it for a short amount of time and then point back towards up. Okay, here's our risk-reward ratio. Maximum risk in this trade is 60 cents a share, or $60 per block of 100, and the maximum gain is $1.40 a share. And so to hit that gain, we need to travel up considerably. So we have to go to 314 to hit that maximum gain. And a lot of our gain on the underlying will just be paying off that downside protection we've purchased. So we're getting so close to that 315 where I think it's going to be a highly risky zone to own the SPY without a phase one trade deal. So can't wait to flip the option collar for the SPY to profit from the downside. I just don't think we're there yet. We don't have the catalyst and we don't have any momentum to the downside. The call option market's clearly betting up. So for now, we continue to cautiously bet up on equities, stock, bonds, and gold at the same time. Okay, moving along to the content I've collected. The order of the content is first news related to China, second U.S. business news, third political U.S. news, and then fourth the charts. And that's the order of importance to predicting the markets right now. Okay, so China is not happy about Hong Kong. I listened to an interesting interview with Jim Rogers, who is big time pro-China. He's teaching his kids Mandarin, and he thinks Asia's the future. He thinks that they may just shut down Hong Kong and the Hong Kong dollar altogether and move everything to Shanghai. The problem is no one trusts Chinese law, and unless they make some major changes to their law, I don't think anyone will. So not sure about that, maybe way down the road. For now, Hong Kong's critical for China being able to raise capital. In fact, Alibaba just did a second IPO in the Hong Kong exchange, raising $12 billion. Which is interesting. Why is Alibaba, after having all these record-breaking profits, needing more cash? Well, the bad news for Alibaba is that China, because of its state-owned enterprises, it's taking profits from the good companies and using it to subsidize all the weak companies. And this is their goal, to have a strong unit where everybody has a job. And so that's the strength and weakness of China. They can collectively take all of their work and take over an industry like Huawei, where they're out selling phones at a loss, just to take over the industry. And they quickly did. They're the #1 phone seller in the world by far. Okay, so we read these two. Let's skip down a little bit. Global markets slide, not much, after China says it's ready for the worst case scenario following the Senate vote in support for Hong Kong. Now the House is going to do another vote for something else Wednesday. I don't think that will add much more drama to the scene, as this already came out. 3 bottom lines China will not tolerate: 1, undermining of national sovereignty and security; 2, challenging the authority of the central government or basic law; and 3, using Hong Kong for infiltration or sabotage against the mainland. Some photos from Hong Kong. It is in chaos, and the time to short there. Hong Kong dollar may be coming soon. I'd like to see some weakness in CNH or CNY, the 2 currencies for China, to give us an indicator that things are going sour, that they're losing control of their currency, and that it's time to short their currencies. So China, it's really not good for their currency to lose value, because it shows that they're losing power in the world. And all the people that own this currency, they are not allowed to sell it or get it out of the country. So they're stuck with all their savings losing value rapidly. Which is why there's been so much money trying to flow out of that into Bitcoin and gold all year, in every single way they can find. Right now, the biggest secret is to go set up a company in Japan. Then you can wire money to Japan, and then you can transfer it out. So I guess that's the biggest loophole. And thousands of these LLCs are popping up in Japan to do this right now. The U.S. has turned Hong Kong into the focus of China-U.S. competition. It's all the people in Hong Kong, including foreigners and foreign companies, that suffer. The mainland only feels limited pain. Beijing has no reason to back off on issues of sovereignty and let Hong Kong be at U.S.'s disposal. Few Chinese believe that China and the U.S. can reach a deal soon, given current poor China policy of the U.S. People tend to believe that significance of a trade deal, if reached, will be limited. China wants a deal, but is prepared for the worst-case scenario, a prolonged trade war. Paul Keating. China is the dominant economic power in Asia. The question is how Australia responds to this. Pax Americana was an aberration. Australia should get over its alarm at the speed of China's rise and recognize its achievement in lifting 700 million people out of poverty. It's funny, nobody who's anywhere near China is very happy about that. In fact, they're all alarmed because China is slowly buying out politicians and trying to influence their law, whether it's Taiwan, Hong Kong, Australia. Now, this just kind of symbolizes what China's been out doing. There's all sorts of people flying to this airport to show it off. It's beautiful. It's remarkable. But what do you notice about every photo of this spectacular, I think it's a $12 billion airport? There's nobody in it. Their train cars are empty. So they've built all this great stuff, but it's way ahead of itself. And so it's a huge misallocation of capital. Probably the most in all of history has been accomplished by China in the last decade. And that's just so they can try to keep these 700 million people out of poverty. It remains unclear whether Trump will veto the bill, opening himself up to accusations. He's been in bed with Beijing all along. So far, Trump has not indicated whether he would sign the legislation if it gets to his desk. So I expect he'll delay any word about it until we either get a deal or not. But all these politicians know that passing this was a double win. It makes them look good, plus it puts pressure on Trump. Nancy Pelosi of the U.S. Senate has now joined the House of Representatives in passing the Hong Kong Human Rights and Democracy Act. The people of Hong Kong have woke up to the news that both branches of U.S. Congress stand with you in your fight for democracy and the rule of law. I'm not sure who this guy is, but it was retweeted by that communist leader guy. Most powerful men in the world. Interesting order. Xi Jinping, Putin, and then Trump. And then he's got Bezos, the Pope, Bill Gates, MBS, Mahdi, Macron, Zuckerberg. I don't know about that. and then it goes down the. Now Jack Ma certainly isn't. Jack Ma had to sign over Alibaba to China. That's what happens when you create a $100 billion company in China. You get to give it up to the party. Chinese spokesman, U.S. Secretary of State Pompeo said U.S. is gravely concerned by unrest in Hong Kong. We urge the U.S. to respect China's sovereignty, stop making irresponsible remarks, stop condoning violent crimes in a disguised manner, and stop meddling in China's internal affairs. Like the 1990s, Japan will be dominated by huge zombie banks. Remember, they just bailed out another $80 billion to a bank. I think there's been something like 7 big banks this year that have been bailed out by China. Construction companies are going out left and right. And so they need stuff to build, but there's not enough demand for what they want to build. So they've been creating debt all around the Belt and Road Initiative with all these little countries. Those countries can't pay the debts. So it's just turning into a nightmare here. China is lowering interest rates, finally starting to follow suit with the rest of the central banks. And again, their whole goal of de-dollarizing the dollar isn't working out so well. Now, Jim Rogers believes that this will escalate, that the dollar will go extremely high, and then that will be the end of the run for the dollar. So we'll see if that plays out. A lot of guys have been trying to predict the end of the dollar for quite some time. And it's interesting that we're actually in a predicament where if we do get a phase one deal, the Fed suddenly won't be cutting rates. We may have the risk of the bond market really getting upset and having yields rise. As the yields rise, that can create a flow of money out of stocks. So it's not really clear if we actually do want a phase one deal for the U.S. to be in a better position in the short term. What has worked really well for the U.S. is just these tiny tariffs that slowly eat away at China, puts more pressure on China, which causes more pain for all the surrounding countries and drives capital to the U.S. It's allowing us to fund these gigantic deficits. And for now, we haven't seen the slowdown reach the U.S. Now, with that said, earnings growth has been deaccelerating to negative territory as of the latest month. And the GDP print in the U.S. is supposed to be below 1%, which would be very low. So the global slowdown will eventually work its way over here. But for now, just a little bit of shaking up emerging markets has been very beneficial for U.S. assets, from the dollar to being able to fund our government's debt very cheaply, and also for pushing money into the stock market. Meanwhile, global trade is slowing down and in negative growth territory in terms of volume. World Trade Organization says global trade continued downward in Q3 and will likely stay that way through Q4. That's on top of trade volume that up to Q2 is the weakest it had been since 2009. 3 straight quarterly contractions already will probably become the 4th and then the 5th. This does show the slowdown in the trade volume, although it is at high levels. China's annual aluminum consumption to decline for the first time in 30 years. McConnell passes the Hong Kong human rights and tweets about it. Alibaba raises $13 billion in a secondary listing in Hong Kong. Hong Kong update: protesters are calling for a subway disruption and road blockades starting as early as 5 a.m. Wednesday, according to a social media post. Demonstrators trickled out of PolyU Tuesday evening. Some were arrested. So this is not the first show for Hong Kong protesters. They've been doing this about every 5 years, really, whenever China tries to take away some of their rights. So they are well conditioned to fight to the end until China backs off. So now that they have the support of America, I can see this becoming the pivotal moment where bloodshed hits China, or rather Hong Kong, and Trump uses that to get all the allies to team up against China. Now think back to World War I. We did the same thing against Germany with reparations. They couldn't pay it. They were the biggest economy in Europe, And when they went belly up, it caused the rest of the world to go into a Great Depression. Their currency hyperinflated. They started inventing new currencies, all kinds of gimmicks and schemes to try to be able to survive. And at the end of the day, caused their currency to blow out and a Great Depression. And this was during the 1920s. We had all-time high stock markets in the U.S. Everything was grand, very similar to what we're experiencing right now. But eventually, the global slowdown reaches its way and causes pain for everyone. So we're seeing very similar outline playing out right now. The U.S.-China trade deal that fell apart 6 months ago has become the benchmark to decide how much tariffs should be cut in the initial phase of a new accord. And so they're talking about rolling back some of the tariffs. So it does seem like they still are hopeful for a trade deal. But U.S. President Trump is getting less and less hopeful. You can hear it. I like to listen to all his press conferences. Not necessarily what he's talking about for the bulk of it, but the Q&A after is so critical because that's where you get kind of his on-the-whim feeling of what's going on with the trade deal. And he says that he will raise tariffs even higher if trade deal is not reached. So right now we have some $350 billion of goods. They'll get a 15% tariff on December 15th. Right now that's scheduled. What else? Who knows? Bloomberg, there's widespread skepticism on both sides that the countries would ever reach a second phase agreement that would tackle structural reforms. So even if we do get a phase 1 deal, can we get a phase 2 deal? North Korea says it will not offer anything for Trump to brag about without receiving in return. So poor North Korea is still really struggling with all these sanctions put on them as we wait to tie it into the U.S. trade deal. Rabobank, if Trump gets wind that China is ignoring him, it raises risk of a shock tariff hike. That's becoming more and more likely by the minute. Central bank balance sheets surging. So we can see the high was 21 trillion. They tried to sell off some in 2018. We had 98% of all asset classes close the year at a loss. Only thing that went up was like VIX indexes. And now they're back to growing the balance sheet. So we'll see how much money they print this round. Companies to have reached a 4% weight in the S&P 500 from 1990 to date. So we've got Microsoft hitting a huge spike and then crashing. General Electric. These are companies who I think hit the $1 trillion mark in some cases. At least Cisco did. Cisco never came back from that level. ExxonMobil, and now we have Apple at just extremely high valuations. Here's a look at the percentage drawdowns in Apple. The biggest one was 58% in 2009. What they've done is really clever. They just buy back their own shares. So there's less and less shares in the market. And they're on track to completely buy out all open shares by 2030 at this pace. I don't think they'll do that because it would cause the price to get outrageous. But variance from the 50-day moving average and drawdowns. So you can see we have varied greatly from the 50-day moving average. We're in overbought territory. So I do suspect a sell-off. Depending on when the phase 1 trade deal breaks down, it could be quite significant in terms of speed, but I don't think it'll last for very long. Here's a look at Apple's chart, just screaming higher after that December pullback. Nearly up 100% from that low of 150. Absolutely insane. But the low bond term premia are unlikely to persist much longer. The Fed's actions have reduced the risk of a recession and increased the risk of higher inflation, yet this has barely been priced into the bond market valuations. Moreover, term premia should rise over time as chronic budget deficits require large increases in the supply of Treasury debt. Not only does the Congressional Budget Office project large deficits as far as the eye can see, But as bond yields rise, debt service costs will increase, leading to bigger budget deficits and even more supply. So that right there really summarizes why the Fed is trapped. They have to give the impression that rates will slowly go lower, pushing bond prices higher, and they're going to be buying up treasuries to support the market for any lack of demand. So that's where we're at. They have a little room to continue doing this, and then the game's up. So we're at 1.5 to 1.75. If they get lucky and we get a phase one trade deal, I think they could maybe do a cut every 3 to 6 months and keep the bond market happy and holding, expecting to have a potential capital gain. Of course, who's going to buy that? The Fed. So they're thinking they can generate a profit from buying government debt and selling it to the Fed. And that's what's keeping the whole credit market together right now, not just in the U.S., but worldwide. Either the government's not funded or this is just trapped in this lower range. Now we're seeing the Fed actually talk about potentially going below zero, and they're saying it worked well for Europe. So we'll see if that happens. But so far, again, they're doing the same thing. We're on hold, and then a couple days before the announcement, 25 basis point cut sounds good. So I do think they will hold through December unless the trade war escalates. And Trump knows that because the next Fed meeting won't be till February. So if he wants any chance of a rate cut anytime soon, he has to escalate well before the announcement where they make the decision on December 11th and 12th. So really running out of time. Saxo Bank, there's so much liquidity that's been injected into the stock market over the past years, it's now almost impossible to withdraw it. The only solution is to keep injecting liquidity, which explains why around 60% of central banks are easing globally. Meanwhile, there is someone who lost a ton of money because the banks are having to borrow $180 billion at a time. So $74 billion is what we just lent overnight from the Fed to the banks. And what they do with that, we don't know. It's top secret. They won't allow any audits. And again, the Federal Reserve's nothing federal about it. It's owned by these banks. The IMF did a study on hyperinflation in numerous countries. There were 5 data points that were found to be common in all those countries that experienced high inflation. 5 of them can be found in the U.S. now, although I think the country that will have hyperinflation will be China. After inflation, yields on benchmark bonds are yielding less than zero. Okay, so you look at your yield, compare it to the inflation rate, you're losing money. That's the case with almost all bonds. And only reason people are holding it is because they know the central banks will lower rates, buy up debt, and let everybody out of these bonds for a profit. Now, how long can they do it? They could do it for a very long time. Look at what Japan has done. They've just been keeping at this 0% and even negative 0.10% rate for a long time, but they've had no growth. Their stock market's been down for decades, so it's not ideal. So would that work? I think they can only get away with that because there's a positive yielding outlet in the U.S. A lot of the bond experts don't think the U.S. could get to that negative rate because there'd be zero positive yielding bonds for an outlet in the market. So it's a little bit above my pay grade, but as we get close to zero, that will most likely mark the near top in the bond market. America's big banks are getting further relief from capital demands as U.S. regulators set up a new approach for measuring risk. Bottom line is they've freed up 9% of their assets with changing the regulators' rules. Retail's starting to slow down a little bit. Saw some bad reports from Home Depot and Kohl's, but some of the other retailers are doing well. So kind of a mixed bag there. Fed President John Williams called both the economy and monetary policy in a good place, but added he's definitely watching for more downside risks. Below target U.S. inflation and a slowdown in global growth. So it's hard to create inflation when companies get free money and they can go sell products at a loss, which keeps prices low. So where's the prick in the bubble? Well, the big problem is rent has gone up. Half the population can't pay their rent, and they're going to vote for leaders who are going to change the political system dramatically. So that may be what ends up popping the bubble here. Here's the funny photograph or cartoon, trying to audit the Fed. Oh no, the private banks want to hold on to all their money. They're getting bailouts. Why do the banks get to control the money supply? That doesn't make any sense. So this was put together after World War I, and in top secret. They pick a name that sounds like it's ran by the government, but it's really not. So this is something that hopefully will change in my lifetime. But for now, this is the single biggest impactor of the markets, is the central bank. And in our webinar, we'll see how we can look at what the Fed's doing to predict the two main markets, the stock market and the bond market, in terms of looking at where rates are. And we're going to go back for a whole century of what's happened with inflation, rates, and monetary policy. Fed Williams, this year's interest cuts have been very effective. Monetary policy is now well positioned. Inflation's low, unemployment is low, very close to achieving inflation target. Okay, now we're in our political news. Adam Schiff, the question is, are we prepared to accept that a president can leverage official acts to get an investigation of a political rival? Our founding fathers drafted the remedy of impeachment so we would have a mechanism where corruption comes from the highest office of the land. Nancy Pelosi, today the American people hear from EU Ambassador Gordon Sondland, a Trump appointee who confirmed he followed the president's order to pressure Ukraine into investigating Trump's political rival. Rep. Matt Gaetz, it appears the new Democratic strategy is to replace the quality of witnesses with an overwhelming quantity of people. The problem is the witnesses either lack personal knowledge of the facts or they have devolved into such a policy of disagreement with POTUS it clouds their objectivity. Trump. Nancy Pelosi will go down as the least productive speaker of the House in history. She is dominated by AOC plus 3 and the radical left. Mexico and Canada, after waiting for 6 months to be approved, are ready to flee. And who can blame them? Too bad. I'm talking about the UMCA deal. Since the day of President took office, House Democrats have ignored working Americans to focus on their only real agenda, impeachment. Meanwhile, our country created $11 trillion in worth. Tonight, in the 5th Democratic presidential debate, which means we need your help to make today a very big day, one that will send an unmistakable message to the establishment and media about our campaign's strength. So we got the next primary. It looks like we need to start following Pete Buttigieg instead of Elizabeth Warren. So I'll probably add him to my Twitter and give Elizabeth Warren a little more time to stay in the polls, but she's starting to lose some of her polling power. Joe Biden's hanging in there, although really all the focus has been on the call and not about what Joe Biden was up to for the last, while he was sitting vice president in Ukraine and China. A lot of dirt on him. I highly doubt Joe Biden has a chance. Elizabeth Warren, I think, has mass appeal to poor folks. Bernie, we've seen the Democrats just stab in the back every time he has a hurrah, so I don't think people trust he could do it. And then we got Pete Buttigieg, who's fresh. So we'll see how he continues to pull here and perform in tonight's debate. We need to put the power back where it belongs, with tenants, not with big corporate landlords. 90% of landlords were represented by lawyers. 90% of tenants were not. Medicare for all is the best way to cover every person in America at the lowest possible cost. I've laid out my plan to pay for it. I wonder how many doctor visits people will make that are not necessary when they don't have to pay for anything. Meanwhile, the Epstein case is coming back. Guards have been arrested, and so this drama continues to unfold. ABC is getting hit for suppressing a bunch of facts they had on this and witnesses. And meanwhile, Kanye has gone all out Christian. He won't sing his old music. He's got this huge following, and he says he's running for president in 2024. I'm just really focusing on trends happening in the U.S., trying to predict political outcomes. Government debt per person. Japan has the most, $90,000 a person. Ireland, part of Ireland went bankrupt from a Green Deal fraud, about some $4 billion loss, trying to go green. U.S., $61,000. And the guy who posted this was pointing out that China's not on the list. But you got to realize they have 1.4 billion people. So if their debt was even above 10,000, it would be a greater total debt than the U.S. Proportion of society that's comfortable with female heads of government. And you can see it's only in democracies primarily. The charts to wrap us up, SPY ETF going sky high. We're in bubble mode, melt up mode. I think 315 will be hard to get above without a phase one trade deal. Without it, we'll probably be right back below 300 pretty quickly. LQD is the best ETF to follow. That's your investment grade bond ETF. This is what's fueling the stock market. The banks loan money to the corporations. The corporations take that money and they buy back their own stock. As long as the Fed keeps rates low and continues to buy treasuries for a profit from the banks, banks are going to keep loaning money to the corporations. The corporations are going to keep buying back their own stocks. So if this LQD starts to nosedive, or probably maybe even first the TLT, that's when we want to get bearish on stocks for a longer period of time. And we're talking about probably around 111 on the TLT and LQD before rates become really problematic for stocks. Here's a look at the TLT. Had quite a sell-off from getting ahead of itself with the phase one trade deal news, but now the phase one trade deal's phasing off, fading away, and we can see TLT's right back to its ascent. And again, unless we want to not fund the government, this has to go higher. Here's a look at TLT, and you can see, sure, it has these pullbacks all the time, but in general, it has to travel higher. This is what keeps the bond market intact. The second this starts to sell off, we've got a lot of problems. Here's a look at emerging markets over the last decade, and it's primed to shoot up above 52 if they can keep adding to its debt levels. But if it cannot get access to capital and we put pressure on it, my target for this could be back down to that 28 level we saw in 2016, which it managed to do with no pressure from the U.S. They did that all on their own, just from all the bad investments they've made. And those bad investments have continued. So the problem's much worse than it was in 2015 when they almost crashed. But now you've got a major power putting pressure on them. This could probably go towards 20 from here if we do get pressure. So I would be very excited to point our option caller down on emerging markets, as I think we can make a lot of profit from that. For now, we're still pointing up because we don't have that pressure yet. Here's your look at GDX. I do suspect within 2 years this will be well above its recent high of 65, and that's just because there's so much more debt that has to be serviced. The central bank's balance sheets are going to grow from 21 trillion, probably considerably higher. Maybe they stop around 30 trillion, 40 trillion, who knows? In the next decade, that level is going to grow rapidly as they try to delay making the bond market pop. We'll see how long that can last, but for sure, GDX has a lot of upside, almost no matter what happens with the trade deal. This is the currency that most likely is traveling much higher in terms of weakening CNH against the dollar. In our boot camp, we're dying to short CNH. We've been holding back until we see this phase one trade deal really fall out and we get the tariffs. And so expect to start shorting this currency very soon if you're in our boot camp program. It can be highly profitable to use the futures market to short their currency. Now, if they do create a phase one trade deal, this could strengthen. So that's why we've been holding back and waiting for it. Now, the great news is if Trump does dramatically increase the tariffs more than we've seen, this could probably go to around 8, maybe 7.8 to 8, depending on how many tariffs are actually applied and what that timeline looks like. So that would be anywhere from an $8,000 to $10,000 profit per option or futures contract if we can get a 80 cent to dollar push on the conversion rate, which is not too unrealistic. We have seen just from mild tariffs so far about that big of a move from the 2017 low to the 2019 high. And that was with very mild small tariffs slowly applied. So we can see how they've reacted to that. Wait till we put huge pressure. Who knows just how low this conversion rate could get. Gold is being bought up by central banks at record pace as they print money at record pace. This theme most likely will not stop because, again, we have so much debt to service. The interest alone is causing the banks to continue to lower rates and print money. So as long as that's happening, assets that can't be printed go up. So assets that have limited supply like stocks, bonds, real estate, and gold are going up in value the more that the bankers print money. Crude oil, I like to keep an eye on. If it gets too hot, I want to be bearish on the TLT. If it gets too low, I want to be bearish on the SPY. At 60, it's perfectly fine. The German 30-year bond is our best way to look at the health of the bond market. You can see it's in a clear downtrend over the last 5 years. This is from China's slowdown, and this is their main trading partner. So my expectation is this will dive into negative territory on the news of the trade deal breaking down. And you can see the correlation. Now, the U.S. bond market in the 30-year is not sloping down like the German one, but it does have a very similar shape. And so this is the best leading indicator for where the bond market's headed. And quite clearly, that's lower. Now, what could change this? Well, a phase one trade deal would probably pop these yields up for a little bit, but we're back to the position where, hey, we're creating less GDP than we are growth. To create the growth, we're creating more debt than we are GDP. So it's just, the whole idea behind the government creating money is that it'll go get binged around in the economy and create a bunch of GDP growth. But instead, we're not seeing that. In fact, for China, they have to invest $7 to get $1 of growth. In the U.S., it's more like $1.50 to get $1 of growth. So that's not good. And meanwhile, with all the dovish moves of the Fed, you think the dollar would be in decline, but no, it's not. And I expect this could potentially travel dramatically higher if this trade deal does start to break down. Because once again, China devalues, forces all of their trading partners to devalue, makes the dollar-denominated debt more expensive, which causes them to print even more money to fund these debts. So we may actually be playing the dollar to the upside and China to the downside in the boot camp trades. All right, here's the last chart. We're looking at crypto. As long as these are highly elevated, investors are still trying to get their money out of their local currency, away from the government where no one can touch it. That's the real value Bitcoin and Ethereum offer. And so they still remain at these elevated prices, and we still remain long with a tiny position in our portfolio. We've never had more than 2.5% exposure to cryptocurrencies, and right now it's at 2%. So very correlated to gold, and just a tiny part of our portfolio. All right, guys, that's a wrap for today's presentation. Don't forget you can call Dean to reserve your spot for a free consultation, 505-322-7515. And tomorrow's our free webinar at 2 Eastern. We're going to go through the big picture, and we're primarily going to be studying what the central banks have done over the last 100 years and how that's impacted the markets, and why we're really out of room to keep doing what they've done for the last 40 years. So you think we're in an 11-year business cycle. Really, we're in a 40-year business cycle. And the little magic trick they've used to drop rates and print money is running out of room. So they can go another 150 basis points, and then that's it. That's the end of the game for goosing the stock market. SD Trader 11, thank you so much for your comment, and I hope everybody enjoyed today's presentation. We have our paid member webinar coming up in an hour, and we'll just summarize all this. Won't be a whole lot different. And tomorrow's our freebie webinar, so thank you so much.